At the end of this week's video, you might be left saying, I feel like I've heard some of that before. The reason I'm trying once again is the messages are that important. Stick around. So this week, we're gonna talk about trade-offs. Before you tune me out and say, hey, Tim, you've talked about trade-offs before, why am I bringing it up? Well, there's been a lot of things happening that have gotten people a little rattled. A lot of people approaching year end, retiring, a lot of people selling their businesses and capital gains coming up in mind. The September 5% correction got a lot of people's attention after the a run that was double the historic average without a 5% drop. And of course, you're starting to hear about interest rates, maybe the Fed raising rates sooner rather than later. And so as an investor, there's just a lot of things that have got people concerned, or in a lot of cases, what we're seeing for people who have transitioned their businesses or who are transitioning into retirement, that can be very paralyzing. It's really hard to know where you can more safely step. Here's the good news, the bad news, that's the title. You're damned if you do, you're double damned if you don't. There are no easy choices right now. Your days of getting to put your money in a money market and get 6-7% or buy a AAA muni and get 6-7% tax-free, they're gone, right? And at the same time, not doing anything, that's the double damn, right? If you get into, still stay with those traditional fixed income assets at 1%, you've got some serious interest rate risk. We're gonna talk about that. If you just hold cash, or again, if you're holding low yielding fixed income, you've got a serious inflation issue on your hands. So again, what's the setup? What's the drive? What's the concern? Why the need to act? Well, if you have oodles and oodles of money and don't care about drawing it down into your passing, then maybe you don't have any concerns. For the rest of us, the big issue is the longevity of your account. Alan Roth of Wealth Logic put it this way: my modeling shows a 3% spend rate is good for about 25 years of life expectancy, but those life expectancies have dramatically increased. So perhaps a 65-year-old couple should use something like 2 to 2.5%. Well, let's put this in some numbers that people maybe understand. If you're spending $80,000 to $100,000 a year, which is most people, you would need $4 million of retirement assets to safely take that distribution according to his modeling. Most people I know who have $4 million are used to a lifestyle a little bit bigger than 100 grand. And most people who are living on $100,000 a year, have that as their current lifestyle, find it very difficult to amass $4 million over a career. We'll get to some of the solutions around that problem. The second problem is one of the big catalysts of your portfolio, that 40% in that classic 60-40 mix in fixed income, is giving you nothing right now. You've got those twin dangers, if you will. This is, again, the double damming of either interest rates going up and pushing your value down, or inflation hunting you down. As to the first in interest rates, and really how big is this risk, Tim? Well, a 1% move in rates would equate, depending on what type of bond you own in terms of the length of its maturity, from a 2 to a 20% potential loss in that scenario. Significant. So not only not getting you any yield, not being that conservative buffer, but actually bringing significant danger to a part of your portfolio, in addition to stocks or real estate, where you really can't afford to have that kind of risk or have that kind of drawdown. For a lot of people, I know change is scary. It seems like staying the course is the right thing. I know a lot of advisors who are paralyzed, continuing to do what they've done for the last 20 years moving forward, or for investors, hey, this is what my dad did. The reality is inflation, as we're coming up on Halloween here, is that zombie that's just slowly and methodically chasing you down. If you stand there too long, you're gonna get caught. And so how do we move past that? How do we preserve purchasing power in the face of inflation that, again, is coming in at 3 to 4%? Well, let's touch on some quick solutions. Number one is, again, mindset. Mindset's everything as an investor. We need to embrace volatility. We need to understand the difference between volatility and risk. Risk is not reaching your goals. Risk is permanent loss of money. Risk is running out of money before you die. That's the things that really have people afraid. And what you need to do, again, this is the damned if you do part, the unescapable truth and trade-off, is to be able to get into portfolios and positions that will, given time, help get you where you want to go. You're going to need to embrace some volatility. To analogize this, we need to leave the shore. We've got to get into the boat. We know there's going to be weather. We know there's going to be waves. But the only way to cross that divide to where we want to go is to get in the boat and make it happen. For a lot of people, I know that's a tough thing, but again, it's doable. So when we get in, Tim, what kind of assurances, what kind of history do you have to lean on to suggest that we can make it? Well, if we go back to that 2 to 2.5% that really isn't livable for most people, or you think about trying to take the 4 to 5%, which is what most people do, that really would bring in some serious longevity questions, and we've touched on this countless times. Again, coming back to income, can you generate the cash flow? Where longevity comes in is when you're having to sell things off. If we can avoid having to sell things off by getting into asset classes and strategies that can generate the sufficient income that we need, we can avoid that risk. That again is quite doable. The second big thing is looking at alternatives. Here's some things for you to keep in mind. In the last 25 years, there have been 11 times where the treasuries have spiked by 100 basis points. And all 11 times, the bond market has posted a negative return during that time frame. Okay? And that was coming from much, much higher interest rate levels than where we're at today with a lot more risk. That ball is being held a lot further underwater. Things like market neutral, and again, there's good and bad. You need to have someone who knows where they're doing here. But things like market neutral strategies have posted positive returns in almost all 11 of those scenarios, depending on the strategy, but for almost all of them, the vast majority of them. It's an idea of a different alternative strategy. Yes, past performance is not indicative of future returns, but the kinds of things we want to look for, understanding the investing environment we're in. Real estate, if you go back to 1978, there have been 7 times where the Fed has been hiking rates. In all 7 of those periods, bonds are posting negative returns, and yet the real estate index has posted positive returns in all 7 of those time frames. How do we get in? What types of real estate? What types of market neutral? That's what you're hiring us for in part. But the other part is to know that these things are out there, that this challenge, that these trade-offs that are very real and have some very real dangers are also very addressable. To bring it all together, change and new things can be scary. Here we are again in Halloween season. These zombies, these monsters, they're lurking out there. Inflation is a very real monster that people need to be aware of. Low interest rates, classic portfolio design, very real dangers that are unfortunately going to have very real consequences for a lot of families in making sure that they can maintain their lifestyles and their portfolios through their retirement. Inflation, again, destroying the value of your cash. You may not feel it. Your statement might look the same every year, but if you've been to the store lately or you've tried to buy just about anything, you understand you have lost and you're continuing to lose purchasing power by the day. Don't let that fear of change paralyze you. Again, there's mindsets, there's solutions, there's partners who are out there to help you through these times. For those of you who are working with us now, thank you as always for your support. For those of you watching that think, man, these are some dangers I need to address. I need to make sure I can get away from these zombies successfully. Reach out anytime. Thanks so much.